Here's something no one expected to see this week. The United States, the backbone of the global financial system, has been downgraded. Moody's, one of the world's top credit rating agencies, just stripped America of its pristine AAA rating, cutting it to Aa1. This isn't just a routine adjustment. It's a serious wake-up call, a shockwave through markets, investors, and Washington. The message is clear. The world's largest economy is no longer being treated as risk-free, and that changes everything. Moody's highlighted a concern that has been growing for years. The U.S. government is accumulating more debt than it can sustainably manage. This downgrade was not sudden. It's the result of long-building structural issues. One early warning sign came from the credit markets. Insurance contracts that protect investors against the risk of a government default, known as credit default swaps, were trading at higher levels for the U.S. than for countries like China and even Greece. In simpler terms, investors were willing to pay more to insure themselves against a potential U.S. default than for those other nations, which is highly unusual given the U.S.'s status as a global economic leader. This shift signaled growing concern among market participants, particularly as political uncertainty around the debt ceiling and trade policy intensified. Now, with those concerns converging, Moody's is formally acknowledging the increased risk. So why did Moody's downgrade the U.S. now? It's not just because of political drama or short-term headlines. It's about deeper, long-term structural issues. America's debt has grown significantly, and the interest payments on that debt have risen sharply, far beyond what is typical for countries with similar credit ratings. Looking ahead, spending on entitlement programs, things like Social Security, Medicare, and Medicaid, which provide benefits to retirees, the elderly, and low-income individuals, is expected to increase substantially. These are legally required payments, and they automatically grow as more people qualify and healthcare costs rise. At the same time, tax revenues are expected to remain relatively flat. That means the gap between what the government spends and what it brings in, the federal deficit, will continue to widen. By 2035, that deficit could reach nearly 9% of GDP, up from 6.4% this year. And if the 2017 tax cuts are extended, that alone would add around $4 trillion more to the deficit over the next decade. The 2017 tax cuts refer to the Tax Cuts and Jobs Act, TCJA, signed into law by President Donald Trump in December 2017. It was the most significant overhaul of the U.S. tax code in over 3 decades. In essence, Moody's sees a path where the U.S. keeps spending more than it earns without making meaningful changes. And that's why they believe the downgrade was necessary. And then there's the growing cost of interest. By 2035, just paying interest on the national debt is expected to consume nearly 30% of all federal tax revenue. That's 3 times more than it did just a few years ago. To put that in perspective, countries with the highest credit ratings typically spend only around 1.6% of their revenue on interest. That gap is huge and deeply concerning. What's even more troubling is that this problem isn't limited to federal debt alone. When you include the debts of state and local governments, the total interest burden across all levels of government becomes overwhelming. And here's the hard truth. Moody's doesn't believe that any of the budget plans currently being discussed, no matter which political party is pushing them, will meaningfully fix this. Not over the long term. Moody's didn't hold back. For years, different administrations and Congress have failed to agree on how to seriously reduce the budget deficit. As a result, meaningful action has stalled, and this lack of progress has become the norm. Now, Moody's is simply saying out loud what many have been quietly warning. The U.S. government is losing both the ability and the political will to control its spending. They also pointed to trade policy, noting that higher tariffs, like those introduced under the Trump administration, are likely to slow economic growth in the near term. Still, they expect the U.S. economy to remain strong in the long run, thanks to its size, innovation, and resilience. Here's the key detail. Despite the downgrade, Moody's kept the outlook stable. Why? Because even with all the fiscal challenges, the U.S. still has powerful advantages. an independent Federal Reserve, the U.S. dollar's role as the world's reserve currency, and strong institutions like the Constitution that support long-term stability. Moody's is counting on those strengths to hold, even if the financial outlook gets worse. Looking ahead, this downgrade could make borrowing more expensive for the U.S. Higher interest rates on Treasury bonds are likely. Investor confidence may be shaken. Already, we've seen U.S. stock markets slip in response. This isn't just a technical move by a ratings agency. It's a serious signal about the country's financial credibility, and it could raise the cost of running the government for years to come. In short, this downgrade is a warning. The real question now is, will policymakers in Washington finally pay attention? If you made it this far, hit that like button, subscribe for more clear and honest financial insights, and drop a comment below. Is this the start of something bigger? Stay tuned.